Dawn in Zurich. The Citadel office still sleeps, but one desk glows before the others. Alex, a junior trader, arrives early, chasing the rhythm of a market that never waits.
Solana's been climbing for days. A perfect uptrend. But where do I draw the line? When do I take profit? And how far should I let it fall before I'm wrong?
As price volatility increases, Alex begins to feel the weight of uncertainty. The candles stretch taller, the swings grow sharper, and so does the pressure.
These swings, I don't know how far it can pull back. How do I protect the trade?
The trend is strong, but without a measure of volatility, every candle feels like a risk. Every pullback, a potential collapse.
You're here early, Alex. Let me guess, Solana giving you trouble?
Yeah, the trend looks great, but I have no idea where to put my stop loss. The candles are all over the place. Huge swings, long wicks. I can't tell what's just noise and what's an actual reversal.
That feeling? It's normal. You're missing one thing: context. Those big candles that scare you, they're not random. They're volatility. And volatility can be measured. And that's why you need an indicator to tell you how much price typically moves, so you know exactly how far your stop should be, without guessing, and that's why you need ATR. The average true range, or ATR, measures volatility, the natural rhythm of the market. It won't tell you whether price will rise or fall, but it will tell you how much it typically moves, so you know exactly how much space your trade needs.
So ATR shows me how much room the market needs to breathe, and how far my stop loss should really be.
Let me explain a bit more. A TR was developed by J. Wells Wilder Jr. back in 1978. He wanted a way to measure the market's emotion, its volatility, not whether it's bullish or bearish. Just how strongly it's moving. Think of it as the heartbeat of price.
So ATR is like the market's pulse? How fast or slow it's beating?
Exactly. And right now, both your pulse and the markets are running a little high. That's why ATR matters. It helps you stay calm when the market isn't. So this is the core idea behind ATR. It measures the average volatility of an asset over a set period, usually 14. It doesn't tell you whether the market will go up or down. It only tells you how much price typically moves. Higher ATR means more volatility, lower ATR means calmer markets. And traders use it for three things: setting stop losses, adjusting position size, and spotting when a breakout might actually have strength behind it.
Okay, I get the idea. But how do I actually calculate ATR?
ATR is built from something called the true range, or TR. It looks at today's high minus low, but it also checks the distance from yesterday's close, in case the market gaps. That's why TR always captures the full movement of a candle, even the hidden parts.
So that's why ATR reacts so well to sharp moves. It's measuring every jump, every gap, not just the candle body.
Here's the formula: the true range, the biggest of three numbers, high minus low prev close, low minus prev close. Then average it over 14 periods. That's the ATR, the market's average movement. Once you calculate TR, ATR is just the moving average of those values. It smooths out spikes and gives a stable volatility measure.
Okay, that makes sense. But what are ATR's strengths and weaknesses? When is it reliable, and when should I be careful?
So these are the main strengths and weaknesses of ATR. It works on every time frame, helps you size positions based on volatility, and it's great at spotting when the market shifts from calm to active. But remember, ATR doesn't show direction, only movement. News spikes can distort it, and high ATR can appear in both uptrends and downtrends.
Got it. That helps. But what about real trading situations? Is there an actual example of how I should use ATR in a live setup?
Here's how you'd handle this setup, Alex. You entered on the breakout. That's your green line. Now look at the ATR value at the moment of entry. If ATR is around 4.3, multiplying it by 1.5 gives you roughly 6.5 points of breathing room. That's why your stop loss sits up here at the red line. 1.5 times ATR equals 6.5 points. This protects you from normal volatility. You won't get stopped out by random noise. only if the market truly reverses.
So the stop loss isn't just a guess. It's built around the market's volatility. That actually makes sense now.
Now that you understand ATR, let's look at your Solana setup again. She gestures toward the chart. See how ATR is rising? That means volatility is increasing. If you enter here at the breakout, you'd place your stop loss 2 times ATR below the entry point, and then adjust it dynamically as ATR updates. That's how you keep the trade protected without choking it.
Right. Now I'm actually managing risk like a real quant trader.
In this case, ATR is steadily falling, which tells us volatility is contracting, and the downtrend is losing strength. As price begins to stabilize and form a base, that's your potential reversal zone. If momentum shifts and price breaks upward, you take a long entry with a stop loss size using ATR.
So high ATR helps me manage trends, and low ATR helps me spot reversals. That's more powerful than I expected.
To wrap up, here are some practical tips before you start using ATR in real trades. Always combine ATR with a trend indicator so you understand the direction. Don't use ATR alone for entries. Use it mainly for risk control. Watch for rising ATR during breakouts and falling ATR during quiet consolidations. And remember, comparing current ATR to its longer-term average helps you identify volatility regimes.
That really ties everything together. Thanks, Elena. This makes a lot more sense now.
As the Zurich sun dips behind the lake and the office finally grows quiet, Alex stays behind for a moment. Today was different. With Elena's help, the noise of the market finally started to make sense. For the first time, he understands volatility not as something to fear, but something to measure. A TR wasn't just an indicator. It was the missing piece in how he managed risk. He writes down the lesson carefully, knowing he'll carry it into every trade he makes. Before packing up, Alex reaches for the book Elena recommended. If ATR opened the door, algorithmic thinking will teach him how to walk through it. The markets are fast, unforgiving, always changing. But now he has the tools and the mindset to grow. And so, under the fading Zurich light, a new quant trader begins his journey, one measured step at a time.